Hello and welcome to Prime Property, your weekly real estate reckoner. I'm Nayantara Rai and this is what we have on the show today. The union budget is less than a week away. Will Finance Minister Arun Jaitley provide a booster shot to the realty sector? We get you the sector's wish list. Real Estate Investment Trust or REIT tops the wish list this year. We get you a sneak peek of the tax incentives being worked out by North Block. Even as it shelves the UPA's plans of permitting foreign investors to buy agricultural land, the new government is looking at liberalizing the FDI regime. The minimum built-up area requirement for FDI may be more than halved to 20,000 square meters. And we get commonflow.com to answer viewer queries on Property Doctor. Less than a week left for the first union budget of the Narendra Modi government. So, come 10th July, will Finance Minister Arun Jaitley provide a fillip to the real estate sector? Considering the new government has already announced housing for all by 2020, will Jaitley's maiden budget provide a booster shot for affordable housing? Will the budget make houses more affordable for consumers via interest subventions? Expectations are high, both from builders and consumers. Manasi Gilani tells you more about that wish list.
Real estate industry players are hoping for achhe din from the forthcoming budget. The sector, which is facing huge inventories, is hoping government policy will bring back demand. The developer community is seeking tax and interest rates concessions. Analysts say currently the interest rates charged by banks to developers and home buyers are at an all-time peak and need to be brought down. A notification of infrastructure status to the sector will help ease lending rates to the sector, in addition to incentives to home buyers.
The interest reduction will be increased from wherever it is today. So about 1.5 lakh rupees, the expectation is that it should increase between 3 and 5 lakh rupees. On long-term cheap access to capital, I think there is some work going on. 3, clearly there will be some tax breaks for affordable housing.
Tax reliefs with respect to service tax, VAT and stamp duty is also essential to transform Prime Minister's dream of housing for all by 2022 into a reality.
Government must create a fund that any home purchase in this segment should get a home loan at 6% kind of a rate of interest for a 20 to 30 year period. Microfinancing norms have to be liberated because a lot of people in this particular segment do not have formal documentation which are desired by typical home loan institutions. Also, there are a large chunk of development funds overseas and impact funds which have a mandate to invest in countries like India for this particular segment, but they are unable to come because of policy bottlenecks. Those policies must be reformed. External commercial borrowing norms must be restated for investment into affordable housing segment.
Besides, the industry also wants government to revisit provisions for special residential zones, increase in infrastructure allocation, provisions for land title clarity, moderating rising input costs, and also making provisions for adequate additional sources of funds, including liberalizing foreign investments into the housing sector.
Hopefully the REITs should be announced. Second is that FDI in real estate needs to be liberalized further so that there is private equity that can play in smaller units. Today it's only 50,000 square meters and above that FDI can invest. We're hoping that comes down to 20,000 square meters.
The investors feel far more confident that the tax regime is going to be stable henceforth. So that will be the biggest plus point which we can think through at this point of time, which can come from the budget. And there will be indirect benefits if they say that the GST and all that is going to be rolled out or the transfer pricing is stabilized. All these will also indirectly benefit the industry as well as the foreign investment.
CREDA is also seeking regulations that will cut down red tape and single window clearance process for housing projects.
The real estate sector today is actually a victim of corruption. It's not a product of corruption. No developer likes to wait for 2 years or 3 years to get all the approvals, essentially after having spent hundreds of crores of rupees in buying the land or acquiring the land. And as we know that the land finance is not allowed by RBI. So the kind of bank, NBFCs or HNIs or the private equity institutions which finance for land, that money comes at like 20% per annum IRR upwards. Now, that kind of money after invested cannot wait for 2 to 3 years, and if it does wait, it ultimately adds to the cost, which gets passed on to the end buyer.
The real estate industry is hoping all of its expectations to be met, as it feels that the fund flow into the real estate projects has a trickle-down effect on many associated sectors.
There is long-term sustained demand, and if supported, we believe that it can boost the overall GDP by 2 to 3 percentage points. So it is a sector which again spreads the maximum in the economy. So every rupee that comes into real estate spreads to about 270 different industries. So the spread is outstanding.
Clearly, all these demands are repetitive and raised every year before the government. But will it fructify up ki baar? Will be known only on 10th of July. In Mumbai, Manasvi Gilani.
Sources say North Block has been actively mulling tax breaks for real estate investment trusts or REITs. Think of REITs as listed units of a mutual fund, where the underlying ownership is in a commercial or a rent-yielding retail property. The rental income of the assets owned by the REIT is distributed as dividend to its investors. Not only is this expected to attract capital to a cash-tight sector, but also provide an alternative low entry point for retail investors to invest in real estate. Draft guidelines for REITs were unveiled by the market regulator in September last year, but industry experts had written them off, saying REITs would not be successful unless the finance ministry played ball with tax breaks. So the question is, will those tax benefits find their way into Jaitley's maiden budget? It is a cumbersome legislation, so industry hopes, even if it's not ready in entirety, the finance minister will announce the intention of supplementing tax breaks for REITs. Prime property lands. This is the proposed legislation by the Finance Ministry and the CBDT, or the Central Board of Direct Taxes. There may be no corporate tax exemption for REITs, but a dividend distribution tax or the DDT exemption is likely, but only if the REIT directly owns 100% of the realty assets or wholly owns the SPV holding the physical assets. The new information also suggests that trading of REIT units may get the same tax treatment as equities. So an exemption from paying securities transaction tax is unlikely, but we could see incentives for long-term capital gains tax. There may also be tax exemptions at the time of creation of the REIT and when the REIT distributes the rental income of the realty assets to investors. But the investors' taxation rate for receiving that income will depend on their status. That is, if they're a corporate, an Indian individual, or a non-resident individual, and so on. To get a full perspective of what this tax structure could mean for retail investors and real estate owners, I reached out to EY's Associate Director, Madhav Podar. I began by asking him why REITs could be a game changer.
In the last 3 to 4 years, we have seen a shift in the composition of household savings. Household savings in financial products have come down, and this is accompanied by an increase in the household savings in physical assets such as gold and real estate, which is non-productive. REITs create a productive avenue for investment, and which then contribute to the GDP, thereby bringing down our fiscal deficit. So that's the first large advantage that a REIT brings in. The second big advantage is that REITs, once they come in, all the property acquisitions by a REIT are going to happen at fair values, and that's really going to bring down or curb the black money in the country. Because as of today, real estate transactions, when undertaken at an individual level, there is an element of black money that gets generated. Whereas when REITs undertake these transactions of property purchase and property sales, all of them is going to happen through normal banking channels, thereby reducing the black economy in the country. That's number two. The other thing which one should not forget is with REITs coming in, there are new transactions which will get created. For example, the fees that's paid to the AMC. Hitherto that transaction was not existing. Now with that transaction coming into place, there will be an income tax and service tax on that transaction. There will be a lot of stamp duty collection for the various states, because all the acquisitions and dispositions by a REIT would be subject to stamp duty, so there would be an increase in the stamp duty revenues.
Madhav, we understand REITs in India may not get exemption from corporate tax. How do you react to such a proposal?
Nayantara, for REITs to really take off, there would be a need to give them a corporate tax exemption. having a corporate tax at either the REIT level or the SPV level, whichever entity owns the real estate, would really not work. We've seen this in other places around the globe, that for REITs to take off, it needs to be an entirely pass-through tax regime.
So Madhav, you're disappointed by North Block wanting to levy a corporate tax, but is a corporate tax levied globally? Let's talk about the US, for example. That is considered to be the most mature market for REITs.
So if we look at US, basically there is a corporate tax, but you get a deduction of the amount of dividend that is declared. So while theoretically speaking there is a corporate tax, but practically the corporate tax gets reduced to zero, because if a REIT distributes all the income that it earns, then it gets a deduction of all that distribution that it's done. So the income left in the hands of the REIT is zero, and therefore the corporate tax also comes down to almost zero. Yes, of course, where a REIT has not distributed its income, to that extent it would be subject to corporate tax. But REITs in the US as well as the proposed REIT legislations in India, both of them require a 90% income distribution. So if those rules are followed, then you would effectively end up with zero taxes at the entity where the real estate assets are housed.
Madhav, I want you to now illustrate for our viewers with an example. If a REIT owns the real estate assets wholly, what is it going to mean for investors? We understand in such cases there might be exemption from DDT, and when the REIT receives the rental income as well as when it distributes that income to investors, there will be tax exemptions.
If we take the example of the REITs directly owning the real estate, and let's say there's 100 rupees of property income which comes to the REIT, assuming that there's a 30% of that as expense, so the net income in the hands of the REIT would be 100 minus 30, which would be 70 rupees. Under the current law, there would be a corporate income tax in the hands of the REIT on the 70 rupees. So 70 into 30%, which would be 20 rupees of tax approximately. The balance 50 rupees would be available for distribution, and if there is no dividend distribution tax, then the 50 rupees would get distributed to the investors. What I am proposing or suggesting is that the 30% tax at the REIT level should also be exempt, which means 100 rupees of income comes in, there is 30 rupees of expense, the entire 70 rupees of net income gets distributed to investors without any corporate tax and without any dividend distribution tax.
Okay, so that's an example for all the cases where REITs fully own the real estate assets. Now, if you could help us by illustrating with an example, if a REIT does not fully own the assets, in cases of joint ownership, we understand DDT will be levied. Is that a welcome move?
Sure. So let's take an example where the real estate is owned by an SPV, and let's say that the REIT is a 75% shareholder in the SPV. The balance 25% is held by a third party, and then the REIT has investors over it. In which case, if we take the same example, that the SPV gets an income of 100 rupees, and there is a 30% expense, so you have 100 minus 30, 70 of net income. Now, given that this SPV is owned only 75% by the REIT and it's owned 25% by a third party, if one were to exempt corporate taxes or dividend distribution taxes in such a scenario, then in addition to the REIT, the other shareholder would also get a benefit of such a tax incentive, which may really not be the idea or the intent of the government, because the incentive should be provided only to the REITs and not to third parties.
So Madhav, aren't tax incentives then skewed in favor of REITs fully owning real estate assets? Won't it also become a decider at the time of a REIT creation or be a deciding factor for investors?
Yes, it would be a deciding factor for the person going in to invest into a REIT on whether the REIT owns the real estate, or at least the REIT owns 100% of the SPVs which own the real estate. So, such a law would actually incentivize that there is an alignment of interest, and the REIT owns 100% of the SPVs which own the real estate.
But Madhav, in India, it's not very practical to always own a fully owned asset. The largest of real estate companies in the country have landowners as their partners, and that's to ensure land contiguity.
REITs would be owning completed assets. So, contiguous land shouldn't really be a challenge. Where there are completed assets, it should be possible for REITs to acquire 100% of the asset, or the SPV which is going to be owned by the REIT. It should be possible for the REITs to acquire 100% of the shares of those SPVs.
And there's more news from New Delhi on possible policy changes for real estate. The new government may ease foreign direct norms for the construction sector, something the UPA government had initially planned but was unable to implement. Sources tell Prime Property Amitabh Kant, the Secretary of the Department for Industrial Policy and Promotion of the DIPP, recently met with industry leaders. An announcement is expected post the union budget and could certainly help cash-starved realty firms in accessing capital. Here are the proposed changes. To make more projects eligible for FDI, the government may halve the minimum land requirement to 5 hectares and more than half the minimum built-up area norm to 20,000 square meters from the current 50,000 square meters. This even as CREDAI, the umbrella organization for builders, is pushing for no restrictions on minimum area. Another proposal is to halve the minimum capitalization norm to $5 million. Now, one of the biggest concerns of foreign investors has been exit. While the DIPP is still undecided on maintaining a status quo on a 3-year lock-in period for every FDI tranche, it is considering easing the repatriation norms. Here's how. The investors may be permitted to exit earlier on receipt of occupancy or completion certificate of the project with prior approval of the FIPB. A non-resident investor may be permitted to exit before receiving the occupation of completion certificate by way of transfer to another non-resident. Even without removing the 3-year lock-in period for each FDI tranche, the proposed norms could be a game changer. For the first time ever, the government is entertaining the thought of allowing a foreign investor to sell out to another foreign investor. But what seems to have been shelved is the UPA's plan of allowing FDI in agricultural land. Sources say the new government feels this is too sensitive an issue and not required at the moment. On that note, we'll slip into a short break. On the other side, it's time for Property Doctor this week with CommonFlow.com.